You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Tuesday. Today, we're going to take a look at my top 10 largest holdings. Big news here. Telus is out of my top 10, and I didn't do anything. I didn't buy more of something or injected capital in those companies. It's just, I would say, survival of the fittest, I guess. So Telus is now my 11th largest position. So let's take a look at what it is at the top, because I'm pretty sure you will have a hard time guessing my bottom three. So all those positions are between 3.6 to 8% of my portfolio. So the last one is 3.66, but I'm going to not tell you this one yet. The last two actually are quite a surprise. So number one, largest position. It has been my largest position since I cannot remember when. I actually trimmed that one 3 times already, and I almost did it a 4th time last December, but I hold on to it because my rule for trimming is if a stock goes above 10%, I trim 1 or 2% to bring it down back to like something around 8 or something. And this one got very close to get caught because it was barely at 10%. It was Apple. Looking backward now, looking back, of course, I should have trimmed a 4th time to cash some profit because this is not the year of Apple. Apple is stuck between commercial war between US and China. Things are not going that well for that point. A lot of uncertainties. The numbers are great though, so I don't mind, but now it's sitting at 8% of my portfolios. Second here, could have sold a few shares, I guess, and take even more profit, but it's Alimentation Kushtar, but this one did not hit the 10%. Kushtar has been having a rough 2 years now. Slowdown for the economy. You have revenue that has a hard time growing if you take away all acquisitions. So organic growth is pretty stagnant right now. Profit not growing super fast either, and there is this super huge elephant in the room with the potential or not acquisition of 7-Eleven. So this deal is ongoing. There's always some rumors. It started back in August last year, and it's still a big talk right now. We're going to know more about this one later in the month when they will report their latest quarter. But in the meantime, business as usual. I'm not too worried about this one either. I trust the management team, so it's all good on my side. Number 3, National Bank. My favorite bank. I've been investing in National Bank since 2003. So long love story. I worked there for 15 years as well. So of course that helped to me liking the stock. But besides that obvious bias, if you look at the numbers, this is the one with the strongest dividend triangle, the strongest revenue growth, the strongest earning growth, the strongest dividend growth, the lowest payout ratio for the past 5 and 10 years. Not surprised, it's outperforming other banks. Still, the future is bright for this one. A lot of growth potential with the acquisition of Canadian Western Bank, with their wealth management division that is doing great, and of course capital markets. Now number 4, Microsoft. This one I also trimmed at once. These days it's all sitting good, doing great actually. Big comeback as of the past few months. One of my favorite position. The company has this amazing mix of stable business with their suites of software like Windows, Office 365, Dynamics, and so on. And then they have plenty of growth potential throughout cloud, throughout gaming, AI. So I like this kind of mix of where you have a very solid business model, but on top of that, you find ways to grow even faster. Costco, this one, was greatly overpriced when I bought it at $5.50. Now it's trading at $1,050 and it's still greatly overpriced, right? This one from time to time, I am a bit uncomfortable with the valuation, I must admit. The P ratio is through the roof, but the company is so stable. It's so like reporting high single digit organic growth quarter after quarter. The revenue, the earnings, everything is following. So I'm having a hard time getting let go just because of valuation, because everything else is amazing. And I mean, let's be honest, when you're up by more than like roughly 100% on an investment, you're kind of like comfortable sitting on it for a few while, and it's good. There is still a lot of growth potential for Costco. They're not done growing in North America, and they can still replicate their business model outside on international markets. So in my opinion, they're still on for several years of growth. It's definitely priced though, so it is the type of stock that is priced for perfection. So if at one point Costco shows a slowdown, I won't be surprised to see the stock tank by like 25% in a very short period of time. I kind of expect that it one day it will come, but in the meantime, I still believe a lot of growth to come. Brookfield, number 6. Brookfield, ticker BN, the mother of all the Brookfield companies. This one is doing great. Very solid business model where you are an asset manager charging fees. So you have like that recurring cash flow coming in from investors. And on top of that, they're using their own capital to invest in very long-term assets. The business doing well. The only downside, and I keep repeating it, super complex financial structure, very opaque. It's not for everyone. If one day we hear that management has been cooking the book or anything else like this, wow, that's going to be a big debacle. But I'm willing to take that risk. But I mean, if you want to invest in that kind of business, you have to do your due diligence and ask yourself, are you willing to take this kind of risk where you have to trust management? And if management is wrong, well, you're going to pay a hefty price for that mistake. Number 7. Number 6. 1, 2, 3, 4, 5, 6. No, number 7. Sorry, guys. I'm having a hard time to count now. Visa, ticker V. Is there any more perfect business model than Visa and MasterCard? I mean, they're making a cut on every single transaction. People are buying more and more with credit cards, and they don't even carry the debts on their balance sheet. That's the bank's problem. They just charge the fee. They're the widest transaction network. It's kind of like a perfect business. Just amazing. I wish I had bought it at its IPO. I bought it in 2017 instead. And yet, that is one of my smartest moves in terms of investment. So super happy about it, of course. Number 8, Constellation Software, CSU.TO, the only non-dividend grower in this one. And of course, I mean, it pays like $1 in dividend, but the stock price is around $5,000. So might as well not say that it pays a dividend at all. And that's fine because it's all about capital allocation for them. They are using all their free cash flow to buy more business, generating more free cash flow to buy more business, to generate more free cash flow. Can you imagine this? This is like the gigantic snowball. Problem here, well, valuation, of course. And the second thing is as you grow, finding more stocks, more companies to buy. I mean, it could be very tough. So their pipeline may get thinner or they may have to overpay for a deal. And actually, they are looking at different verticals right now than what they used to, just to change their capital allocation model a little bit to generate more growth. So we'll see how it goes. But I really trust management on this one. Number 8. Number 9, I don't know if you guessed it, Terrave Industries. Kind of crazy. I started this position I don't know, like a year and a half ago, but the stock more than doubled since then. So that's why it jumped literally into the top 10. Grow by acquisition, small cap, the business. Actually, I did a full review on the Moose on the Loose. Same thing for Constellation Software, so you can go back in the episode. But this one is very interesting because they are manufacturing all like the tanks and everything that is related to transportation or storage of natural gas, which is something that a lot of like there's a big part of the market is shifting towards natural gas energy as a source of energy. So having those tanks and the maintenance around those tanks, I mean, Terrave has a very good business model here, highly fragmented market, growth by acquisition. just make it sure. I mean, those companies that are skyrocketing, they could drop by 40% as well overnight, especially because they're small cap. So just be careful with this one. And a latest addition as well to my portfolio. This one I went like big, so I'm not making a big profit yet. I just went for kind of like a full position at like roughly 3.5. Now it's 3.66% of my portfolio. Waste Connections. WCN, that was a play on like defensive mode, like looking at a business that cannot be destroyed, right? It's just like going with contracts, recurring revenue, operating in kind of like an oligopoly landscape, but in their market, most of the time they're in a monopoly. So I love that kind of business. Again, you're going to tell me it's overpriced. Let's talk about it in 10 years. Looks like it's going to do like Costco, and that's pretty much it. If you're looking for more ideas like those, all of those have been selected from the Rockstar list at one point. So the Rockstar list is my starting point to make it a deep dive and take a look at what could be interesting to add to my portfolio. This is a list that filters all dividend payers, Canadian, US, so doing the harder work for me, highlighting companies with revenue growth, dividend growth, and earnings growth. So the perfect dividend triangle, and then I can start doing my research, but at least I narrowed down my research to just a few stocks in a specific sector. You can download the Rockstar for free at moosemarkets.com/rockstars with an S. So moosemarkets.com/rockstars. All right, Moose, that's enough for today. We're going to talk again tomorrow. We're going to talk about why Stantec is skyrocketing. Kind of crazy. Crazy story. So we're going to talk more about this. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.